Will Toronto house prices go lower? I'll spare the monthly real estate statistics analysis. Yes, sales are down compared to 2021, which was an anomaly. I want to discuss the three indicators that I'm looking at to see where the real estate market is going. Let's briefly look at what has happened before we look at what could happen in Toronto's real estate market moving forward. Earlier this year, in January and February, it was wise to buy first, then sell due to strong competition, multiple offers, and bully offers. Whoever bought then and the market shifted early March had to take a hit on the selling price since they had to close on the purchase of the new home at a favorable interest rate. I believe that reflected in the big drop in average Toronto house prices. In February 2022, the average detached in the city of Toronto was 2.073 million. In July 2022, the average detached in the city of Toronto was 1.515 million. Since then, the average detached has hovered between 1.5 to 1.6 million. Whoever bought in February had to get their house ready for sale, put it on the market, sell it in March, and close 90 to 120 days after, which puts the closing date of those sales in the June-July timeframe, which is where we see the biggest drop since the peak of February 2022. Let's look at the current market conditions. Sellers, some, not all, have accepted the market reality and understand January and February prices are long gone. This explains why there's a drop in number of homes for sale coming onto the market. If a homeowner does not need to sell, they'll stay in their home and ride out the market till it bounces back. On the demand side of the real estate market, buyers are being pushed out. At the time of recording this video, a home buyer would have to qualify at over 7.5 percentage points mortgage in order to qualify. There are three indicators that I'm looking at to see when the real estate market will bounce back. 1. Inflation. This is a tricky one for the Bank of Canada since the benchmark rate hikes take 12 to 18 months to filter through the economy. Although they're looking at current data, they make decisions based on where inflation will be in about a year to a year and a half. 2. Exchange rate. The US has exported its inflation problem. As the US dollar gains strength, Canadian inflation will be high. Since imports are bought in US dollar, I'm keeping an eye on the US Federal Reserve. As they increase their benchmark rate to fight their inflation, the US dollar gains strength against other currencies, which is not good for us in Canada. 3. Unemployment. Bank of Canada will continue to increase its benchmark rate to slow down the wage inflation due to the labor shortage that we have in this country by pushing higher unemployment. At the time of recording this video, Canada's unemployment is around 5.2%, and until that figure is well into the 6% range, the Bank of Canada has room to increase its benchmark rate. I believe the real estate markets will continue to be flat till the above three indicators settle down and we have reached some sense of stability. Until then, Toronto's real estate market will be floating along, nothing too exciting, not too high, not too low, until those three indicators have settled. I believe this market presents opportunities for real estate investors who are experiencing skyrocketing rents and higher mortgage rate, which are pushing buyers out of the market into the rental market. The second group are move-up buyers who can take advantage of little to no competition. Check out this video where I discuss what happens if the appraisal value is lower than the purchase price. And until next time, happy home hunting.